How are you there? I hope you're okay. I'm Patrick Kamau Kamure, and I'm the teacher for Advanced Taxation, where I continue teaching you about taxation of the business income. So far we have looked at several things. However, the main idea here is for us to look at how the businesses are taxed. Usually the two businesses under this level, which is the partnership and the limited company. Under the partnership, we said that there are two areas that we need to look at. One is the admission and retirement of a partner during the year, which we have already covered, looked at the question, and that is settled now. We move on to the next one, still under the taxation of the partnership, which is now the conversion of a partnership business into a limited company during the year. So here we are. So as you can see, the main topic is about the taxation of the partnership. And the second now, after the admission and retirement, conversion of a partnership into a limited company during the year. You might have a business whose accounting year started running on 1st of January 2021, and that means that the accounting year will end on 31st of December 2021. So you may find that when you are starting the business, you started as a partnership business. Partnership. And then the partnership operated for a period of 9 months. And then the last 3 months, come for example 1st of October 2021, you decided to go to the registrar of the company and register that partnership as a limited company. So that means that the last 3 months, this business is operated as a limited company. Now, the way we tax the partnership business is very different from the way we tax the limited company. So you want to see, in case you have such a situation, what do you normally do? So here we are, how we do it. Now, the following points are considered in case of conversion. So points considered. Point number 1 is that the taxable income of the partnership is determined separately from the limited company. Now you need to know, using the gross profit method. Only even if accounting profit is provided. Unless stated otherwise. So the key point here to notice this, that the taxable income of the partnership is determined separately from the limited company. So that means that when you're getting the taxable income, you determine the taxable income of the partnership as a separate item from that of the limited company. Like what I had illustrated here, for the first 9 months, you determine the taxable income of that partnership. Then the last 3 months, you determine the taxable income of the limited company. Now we are saying using the gross profit method only. So even if you are given net accounting profit, don't use, and this is the only time that we don't follow the rules that we said, that if you are given the net accounting profit, you have to use the net profit method. If not, then use the gross profit method. Like in this conversion, we don't usually do that. We always use the gross profit method only. Unless we are saying, even if the accounting profit is profit, unless stated otherwise. So we are going to see that there's some situation whereby the examiner, and it's usually for the exam purpose, you'll be told, start with the net accounting profit. If you're told to start with the net accounting profit, then you don't have otherwise. Then you have to use the net profit method. That is point number 1. Point number 2, you need to take note of, is that in partnership, amount paid to the partners i.e. partner salaries, commission, interest on capital, etc. are not allowable expenses. They are non-allowable, what we call non-allowable. However, upon conversion, the partners are considered the directors of the company. Amount paid to them becomes allowable expense. i.e. director's fee, remuneration, director salary, let me continue, salary, all these are relating to the director, commissions, etc. Very important that when you're operating a partnership business, if the partners work in the partnership business, you may end up paying them salary, commission, interest on capital, such. These we said in partnership are usually not allowable. You cannot deduct them against the taxable income. However, upon the conversion, when the partnership is converted into a limited company, we don't have the partners. Those partners are now considered to be the directors of the company. And if you pay them for service rendered, take note of that, for service rendered to the company, as the directors, those amounts now become allowable expense. Now, they are usually called director's fee, director's remuneration, director salary, director commission, but they are all allowable expense. Another item that is supposed to be point number 3, that upon the conversion, the company may issue shares and debentures as sources of additional capital. Now, take note of this. Cost of issuing shares, stroke flotation costs of shares, stroke cost of listing at stock exchange market, is usually allowable expense. And then debenture interest, on the same point, that the debenture interest is usually allowable expense. In the company. So what we are saying is this, that once the company is formed, the company might not have enough money to do the year activities. So they may decide to raise enough extra capital, and this is usually done through issuing shares as well as debentures. Now, we are saying at the point of issuing shares, the cost of issuing shares, which is also called flotation cost, or the cost of listing at stock exchange market, it is usually an allowable expense. We allow them in the limited company. And it can only happen in the limited company because only a company can issue shares. Same case, if the company issue debentures, debentures are forms of loans. So the interest on the debenture is also supposed to be an allowable expense. That is supposed to be point number 3. Then we have the point number 4 to note about the conversion. That in partnership, taxable income is charged tax. Is charged tax on partners after distribution which is done using the income distribution schedule. The income is taxed on the partners at graduated scale rates. At graduated scale rates. This means, in bracket, same way as employment income. Upon the conversion, the limited company is taxed on its own income at corporate tax rate of 30%. That is what we are saying about this point, that in partnership, as we had seen or we had said, once the taxable income is determined, it is charged tax on the partners. We tax the partners themselves. And this we do once you make the distribution using the income distribution schedule. This we saw when we were looking at the taxation of the partnership, admission and retirement. Now, once you distribute, you should tax the partners at graduated scale rates, which is the same as the employment income. So you find that, like for the year 2022, the graduated scale rates for the employment income start from the rate of 10%, it will go to the rate of 25%, and it is stop at the rate of 30%. So once you distribute the income to the partner, you tax them at that rate or at those rates, depending on the income they have. This we are going to see at a later topic. However, when it comes to the limited company, because the company is a separate legal entity from the partners or from the owners, we normally tax the taxable income on the company itself at the rate of fixed, which is 30%. So you determine the taxable income of the company, then tax it at the rate of 30% to get the tax payable by that company. So these are the points that you need to know when we have a conversion of a partnership into a limited company during the year. Now, up to this point, I would want us to look at a question. The question is from May 2017, question number 3B. So, here is the question. The question says this: Wema and Nenda have been running Wenda Enterprise as a partnership sharing profit and losses in the ratio of 2:3 respectively. The following is the income statement of comprehensive income for the firm for the year ended 31st December 2016. where we have the sales, less cost of goods sold, then we have the gross profit, the rent income, foreign exchange gain, interest on fixed deposit account, less expenses, which you have purchase of CCTV camera, impairment loss on go down, website development, debenture interest, audit fees, salaries and wages, director's allowance, legal expenses, loss on rented property, purchase of foreign currency, advertising expense, purchase of computer, insurance, medical expense, bank charges, purchase and installation of computer programs, the net profit. Additional information number 1. The business was converted into a limited company, trading as Dawado Limited with effect from 1st October 2016 and retaining the partners as the directors of the new company. The cost of goods sold include opening stock of 576,000, which was overcast by 20%. The purchases of 2146,000, inclusive of 16% VAT, and closing stock of 675,000, which was undercast by 10%. All revenues and expenses accrued evenly throughout the year, except for specific expenses relating to Dawado Limited as a company. Salaries and wages includes partner salary of 120,000. Legal expense comprise of acquisition of company's title deed, negotiating debenture stock, demand letters to customers, drafting memorandum of association, and then the total. Then Wema was paid consultancy fee of 54,000 for installing CCTV camera in the premises. Advertising expenses include neon sign costing 92,000. The sales figure was inclusive of VAT at the rate of 16%. Director's allowance include commission paid to Nenda of 60,000 for negotiating the business contract. Then required 1. Separate statement of adjusted taxable profit or loss for the Wenda Enterprise and Dawado Limited for the year 2016. Hint, start with net profit, very important. Then number 2, tax payable by or refundable to Dawado Limited for the year 2016. So we are required, number 1, to determine separate statement of adjusted taxable profit or loss for Wenda Enterprise and Dawado Limited for that year. And we are hinted to start with the net profit. So in this case, what we are saying is this. You see, we have a conversion here in the additional information number 1, that the partnership business was converted into a limited company from 1st October 2016. And that can already tell you that the partnership business had lasted for 9 months, and then the limited company lasted for the 3 months. Now, how do you get the taxable income? We made it very clear here that we always use the gross profit method, even if accounting profit is provided. As you can see, there is a net accounting profit provided down there, but we should use the gross profit method. So that means that we should start with the sales, with the cost of sales, we add other taxable operating income, with the allowable expense. But we said unless stated otherwise. So in this case, it is stated otherwise. In the required number 1, we are told, hint, start with the net profit. So if they didn't say that, that's the time that we could have used the gross profit. But now, since they have hinted to us, then we have to use the net profit method. Another thing that we noted is that we must separate the two business, although it is indicated there, but it come out automatically that these are two different businesses. So when you're getting the taxable income, you must separate the partnership from the limited company. So here we go. So we'll come here and say we want to get the taxable income of the partnership and the limited company. For the year ended 31st of December 2016. Now, one thing that we do, again, is to separate the two businesses, the partnership and the limited company. So we'll separate them here. We have the partnership Now, we are using the net profit method. So we'll start with the net profit provided. Now, in the question, the net profit provided in the income statement is 1105,500. But we must separate between the partnership and the limited company. And which base do you use to separate? You can only use the time period, how long it existed. The partnership, 9 months, the limited company, 3 months. So we are going to take 9 out of 12. The other one is 3 out of 12 of the net profit provided, 1105,500. So that we can know how much went to the partnership and how much went to the limited company. So we start with 9, divide by 12, and then you multiply by 1105,500. That gives you 829,125. Then the other one we have 3 over 12 times the net profit, 276,375. Then once you have the two, just as we said using the net profit method, we normally add. And we add 2 items. We said non-allowable expenses in P&L and taxable operating income. So we said we go to the P&L first and look for non-allowable expense in there, in that P&L. So we start off. The first expense in the P&L is the purchase of CCTV camera. CCTV camera, we said that's a fixed asset. Fixed asset we don't usually allow. We later on down here give them the wear and tear allowance. So CCTV camera. And how do you apportion? You apportion on time basis. How long the partnership or the limited company lasted. So 9 over 12, 3 over 12 of, we have 96,000. So we have 9 divided by 12 times 96,000. That gives us 72,000. The other one is 3 over 12 of 96,000, and that gives us 24,000. After that, we go to the next expense in the P&L. Impairment loss on go down. We said impairment is not allowable. It is equivalent to depreciation, which we don't allow. So we add impairment loss. We have 9 over 12, 3 over 12 of, the impairment is 124,600. So we'll have 9 over 12, 9 divided by 12 times 124,600. That gives us 93,450. The other one is 3 over 12 times 124,600. Give us that 150. Then we continue. After impairment, we have the website development. Website development. Website, we said it's a fixed asset, which we need again later on give wear and tear, capital allowance. So website is not allowable. So 9 over 12, 3 over 12. The website that we are given is 130,000. Of 130,000. So we will have 9 out of 12 times 130. That gives us 97,500. The other one is 3 over 12 of the 130, that's 2,500. Then we move on to the next one, debenture interest. We say debenture is usually for the limited company and the interest is allowable. So that is allowable. Audit fee, that is another one that we had said is allowable, is for the business. Salaries and wages is also allowable, is for the business. Director's allowance we said is for the company and is also allowable. Legal expenses, that is also supposed to be allowable. Then we have the loss on rented property. We say that a loss can only be deducted against the income from the same source. So if you have loss from renting, we need to take it to the renting. So it cannot be deducted from the operational activities of the business, operating activity. So that is not allowable under operation. So loss on property, on rented property, we have 9/12, 3/12 of the loss, 36,200. So we will have 9 divided by 12 times 36,200, which we have 27,120. And then 3/12, 90,50. After that, we continue. Purchase of foreign currency. Foreign currency purchase is not even an expense. It's kind of you are converting a one currency into another, from a Kenya shilling to dollars, or from dollars to Kenya shilling. So in that case, you have not incurred anything. You still have your money. The expense that normally arise in case you make a loss in the process of converting your money. But purchasing is not an expense, so it's not allowable. So purchase of foreign currency, so we have 9/12, 3/12 of 344,900. So we will have 9 divided by 12 times 344,900. That gives us 258,675. The other one, 3/12 86,225. We go back. After the purchase of foreign currency, we have advertising expense. Advertising expense that is allowable because it is for the business. The next one is the purchase of computer. That's a fixed asset. We don't allow fixed asset. So computer, 9/12, 3/12. The computer cost is 180,000. So we'll have 9/12 times 180. We have 135,000. And the other one, is 3/12, which give us 45,000. Then we continue. After the computer, there is insurance. Insurance is usually allowable because it is usually for the business. Then medical expense. Medical expenses is also allowable because it is for the business, for the staff, welfare. Bank charges are also allowable. Then we have purchase and installation of computer program. Computer program is a fixed asset. We don't allow fixed asset. So we add computer program. So we have 9/12, 3/12 of 120. So we have 9 divided by 12 of 120. That gives us 90,000. The other one is 3/12 of 120, 30,000. So up to that point, that marked the end of the non-allowable expense in the P&L. We now look for taxable operating income. This is supposed to be taxable operating income. So remember to income omitted in the P&L. And this is where we said we normally find the income omitted from the P&L are usually in the additional information. So we look for them in the additional information. However, we said as long as we go to the additional information, if we find an expense that is relating to the one in the P&L and the information provided tells us that is not allowable, we still come and add it because it is still an allowable expense in the P&L. So if we start with the additional information, number one, we are told the business was converted into a limited liability company, trading as Dawado Limited with effect from 1st October 2016 and retaining the partners as the directors of the company. For that point, there is no income and there is no expense. So there's nothing you can do. So we go to number two. The cost of goods sold included opening stock of 576, which was overcast by 20%. Now, cost of goods sold. Cost is an expense. If you go to the P&L, you'll find it just immediately after sales, deducted from the sales to get the cost of sales. So we are told that in that opening stock, there is opening stock, in that cost of sales, there is opening stock of 576, which was overcast by 20%. So we must ask ourselves, when we overstate the opening stock, what happened to the net profit that we are given here? For you to do that, you must analyze and get how it do affect. You see, to get the cost of sales, we normally say, we normally say it's equivalent to opening stock plus purchases less closing stock. So we are told this opening stock here was overstated. So if you overstate the opening stock, you expect that the the cost of sales will also go up, because we normally take opening stock plus purchases, so positive. So when it is more, the cost of sales will be more. Now, cost of sales is an expense in the income statement. So if you have more expense, what happened to the net profit you end up having down there? It will become less. So this net profit that we have here is less. So how do we adjust? We can only adjust because it is less by adding, and it is the time to add. So we come and add here opening stock overstated. In this, we can only do by taking the 9/12, 3/12. The opening stock that you're told of it's overstating is 576,000. 576,000. Now, somebody may be tempted to just say 576,000 times 20% because we want to get the overstatement. But that is not correct. You see, if this value is overstated, it is telling you that that value is supposed to be 120%. Before the overstatement, it was 100. Now add the 20, it will become 120%. So this figure is 120%. So how about 20% that was overstated? It will be equivalent to what? Cross multiply, this will go up and this will come down. So it means you take this figure, you multiply by 20, and then you divide by 120. So let's see. So it is going to be the 576,000 times 20 divided by 120. And then we multiply by 9/12. So that gives us 96,000 times 9/12. It will give us 72,000. And then 3/12 of 96,000 give you 24,000. So there we have them. And then we continue on the same spot, on the same additional information number 2. We are told that also purchases of 2146,000 inclusive of 16% VAT. So same, if the purchases has VAT, these purchases has VAT, the VAT normally raises up the purchases. And automatically the purchases is up, the cost of sales will also be up. And cost of sales is an expense. When you have more expense, you would expect that this net profit will become less because you have deducted the more cost of sales than you are supposed to. So to correct that mistake, again, you need to add it because this net profit is less because of overstating the purchases through VAT and overstating the cost of sales. So we come here and say VAT in purchases, which is going to be 9 over 12, 3 over 12 of, we have the purchases of 2146. Now, this value, together with the VAT, is at 116%. Now, we want the 16, the VAT. If this is 116, 16 will be equivalent to what? To get the 16, you multiply by 16 out of 116. So, start 9 over 12 times 2146,000 times 16 divided by 116 give us 222,000. So we have 222,000. We do the same for the 3 months. So 3 divided by 12, you multiply by 2146,000 and then times 16 over 116. That gives us 74,000. That is in relation to the VAT in purchases in point number 2. Still on point number 2, we are told the closing stock of 675,000, which was undercut by 10%. So we come back here. This time, it is this closing stock that was undercasted. Now, take note that the closing stock, it go together with the negative because we normally deduct it to get the cost of sales from the opening stock and purchases. So if this figure is less, it's undercast. So you are deducting less figure than you are supposed to deduct. So if this becomes less, automatically the cost of sales will go up because you are deducting lesser figure than you're supposed to be deducting from the opening stock and purchases. So cost of sales will go up. And when expense is more, when cost of sales is more, net profit become less. So that means, again, this net accounting profit being less, we are supposed to add. So closing stock undercast. So in this case, we'll take the 9 over 12, 3 over 12 of the closing stock in point number 2 is 675,000. So if it is undercast, it means that this figure is less by 10%. So if it is less, this figure then is 90%. So if it is 90%, how about the 10%, the undercast? So this is 90, 10% will be equivalent to what? Cross multiply. It will mean that you take this one, this figure, and you multiply by 10 over 90 to get the undercast. So we have 675,000 times 10 divided by 90. That gives us 75,000 times 9 over 12. Give us 56,250. For the other one, it will be 3 divided by 12 times 675,000 times 10 divided by 90. It will be 18,750. Okay, so that is additional information number 2. Then we go to number 3, and don't forget, we are still looking for non-allowable expenses in P&L and taxable operating incomes omitted in the P&L, the 2. So we continue to number 3. All revenues and expenses accrued evenly throughout the year, except for specific expenses relating to Dawad Limited as a company. But that is not specific of which expense or which income. So nothing there. So we go to point 4. Salaries and wages included partner salary of 120,000. So salaries and wages is in the P&L. If you go to the P&L, you find the salaries and wages. In that salaries and wages, there is partner salary. Now, partner salary is not allowable. and it is for the partnership only, because only in the partnership do we have the partner. So we are going to disallow in the partnership only. So we had seen salary is in the P&L, and the salary to partners is not allowable, which in additional information number 4, we are told it's 120,000. So we have 120,000. For the limited company, nothing. Then we go to additional information number 5, where we are told legal expenses comprised. Now, legal expense, if you go to the P&L, you'll find it there. It is there. So we want to determine if there are some components which are not allowable. So it included acquisition of company's title deed. Acquisition of company's title deed is not allowable. Why? Because it is relating to fixed asset land. It's not allowable because of that. And another thing, it is relating to the company. So we don't allow because it's relating to the company and it's land. So we take it to the company. So title deed cost for the company. The amount 50,000. Another one, negotiating debenture stock. If you go to where we talked about expenses of the business, the allowable and unallowable. And allowable number 4, we talked about legal expenses. And we classify the legal expenses that are allowable, the one that are not allowable. If you go to the non-allowable, we said legal costs to negotiate debenture stock, loans and bonds are not allowed. And you need to know debentures, we say it's usually for the company. So we disallow for the company. So debenture costs, which we have for the company 100,000. After that, we have demand letters to customers. Demand letters to customers that we said is allowable. If you go to the allowable legal cost, we said the one relating to the customer letters allowable. Then we have drafting memorandum of association. Memorandum of association, we said it's not allowable, and the legal cost not allowable. And remember, memorandum of association is usually for the company. So this one again goes to the side of the company. So memorandum of association, where we have 60,000. After that, we now go to point number 6. Don't forget, we still look for their non-allowable expense in P&L and taxable operating income omitted in the P&L. So number 6 says, Wema was paid consultancy fee of 54,000 for installing CCTV camera in the premises. Now, consultancy fee, that's an expense. If you go to the P&L, you won't find any of that expense, consultancy. Or the only one you have is the purchase of CCTV, but that is not consultancy. So that we don't want to look at because it is not in the P&L. We go to number 7. Advertising expense include. Advertising expense, you go to the P&L, you'll find it there. We are told it included the neon sign costing 92,000. Neon sign is a fixed asset. We don't allow that. So we add neon sign costs. So we'll take 9/12, 3/12 of neon sign 92,000. So we have 9/12 times 92,000, which we have 69,000. And then for the 3/12 of 92,000, 23,000. There. And then we continue to number 8. The sales figure was inclusive of VAT at the rate of 16%. Now, sales is an income. The income that we want are the one omitted in the P&L. But this sale is already in the P&L, so we don't want that. Number 9, directors' allowance include commission paid to lender of 60,000 for negotiating business contract. Now, director's allowance is an expense, And if you go to the P&L, you'll find it there, director's allowance. So the question is, the one that was paid to Nenda, is it allowable? We said, in partnership, we don't allow anything paid to the partner. Now, when it was a partnership, we don't allow that part. But once it became a company, he became a director. So when you pay for the service rendered, that become allowable. So because we are not told which side it was paid, whether it is in the partnership or company, we assume it accrued evenly throughout the year. So we apportion and now disallow the part that belong to the partnership. So we have here a commission to Nenda. We only disallow 9/12 of 60,000, and that is going to be 45,000. And now there's nothing else that we're supposed to add. After that, we come to the items that we are supposed to less. So we less, of which case we had said we normally less 3 items. The first one is non-taxable. Operating income. In P&L. Also, or investment income. In P&L. And allowable expenses. Not in P&L. Those are the 3 items that we said we normally deduct. So what we said is this: we normally start with the first 2 items, the non-taxable operating income in P&L and all the investment income in P&L. So in the P&L, the first income that we come across is the sale. We know sale is a taxable income. However, there was an additional information number 8, which says the sales figure was inclusive of VAT at the rate of 16%. And we said VAT is not an income to the business, it's the government money. So if it was included in the sales, automatically it increased the net profit. And that is not an income, so it's not supposed to be taxable. So we have VAT in sales. So we take 9/12, 3/12. The sales figure is 5220. And then to get the VAT, you multiply by 16/116. That's what we said on how you get the VAT, being that it is inclusive. So you take 9 divided by 12 times 5220,000. So let me repeat that. That is supposed to be 9 divided by 12 times 5220,000 times 16 divided by 116. And we have 540. Now, for the other one, so it is going to be now 3/12 or 5220,000 times 16/116, give us 180. 180,000. That was the sales. Remember, we are still looking for non-taxable operating income in P&L and all the investment incomes in P&L. The second one is cost of sales. Cost of sales is not an income, so that we should leave out, is an expense. Gross profit is as a result of sales and cost of sales, so does not have an issue. The next one is rental income. Rental income is an investment income. Investment income, we are saying we deduct all of them. So we deduct rental income. So we take 9/12, 3/12 off. The rental income, which is 148,800. So we'll have the 9 divided by 12 times 148,800, which we have 111,600. The same case on the other one. 37,200. We continue. After the rental income, there is foreign exchange gain. Now, about foreign exchange gain, we said we only don't tax if unrealized. If you are told unrealized. But when it is silent or they say realized, that is taxable. Because silence means it's realized already. That's what we assume. And the next one is interest on fixed deposit account. Interest, we said, are investment income. So all investment income, we are saying we should deduct them. So we deduct that. So interests on fixed deposit, which we take 9/12, 3/12 of 80,000. So we'll have 9/12 times 80. That will give us 60,000. And this automatically gives us 20,000 here. Now, that is the end of the incomes in the P&L, the end of non-taxable and investment income in the P&L. We now look for the last part, the allowable expense not in P&L. That an expense that was supposed to be deducted to get the net taxable profit, this one, but it was not deducted. So it is time that we go ahead and deduct. So for this one, if it is not in the P&L, we said it should be in the additional information. Let us check out in the additional information. Number one, the business was converted into a limited liability company, trading as Dawado Limited, with effect from 1st October 2016, and retaining the partners as the directors of the new company. There is no expense there. Number two, we saw the cost of goods sold is in the P&L. So we don't want expense in the P&L. And we saw all the items in number two needed to be added back. They are here. We added all of them back. Then we go to number three. All revenues and expenses accrued evenly throughout the year, except for specific expenses relating to Dawado Limited as a company. There is no expense there. Number four is an expense but in the P&L, salaries and wages. Number five, legal expense is an expense and in the P&L. Number six, consultancy fee. It is an expense and again not in the P&L. This one is not in the P&L because if you look at consultancy fee, go to the P&L and check if there is consultancy fee in the expenses in the P&L. It is not there. But is it allowable? That's the question. Because we want the allowable expense not in P&L. We said because it was paid to a partner, in partnership, we don't allow. But in the company, we don't have the partners, we have directors, so we allow. So we are only going to allow the portion relating to the company. So which we call consultancy fee. So we take only 3/12 of the consultancy fee, which is 54,000. So 3/12 of 54,000. That gives us 13,500. And it's for the company, 13,500. After that, we go to number 7, advertising. Advertising expenses in the P&L. We want the one not in the P&L. Number 8 is about sales figure. That is not an expense. Number 9 is about director's allowance. It's an expense and it is in the P&L. So seems like we are done with the allowable expense not in P&L. However, remember we said that we must always come back here among the expenses that we added back and check out if we disallowed an expense because it's a fixed asset. For fixed assets, we claim capital allowance. We have several. One, CCTV. Website is another fixed asset. The other one is the computer program, and there was a neon sign. This one here. So those one require that we claim the capital allowance. And all of them require wear and tear allowance. So we start one by one, starting with the CCTV. So we claim wear and tear allowance on CCTV, which we take the 9/12, 3/12 of 10% off. 10% off 96. Remember CCTV wear and tear allowance rate is 10%. 96,000. So we take 9 divided by 12 times 10% times 96,000. That gives us 7,200. The other one is 3 over 12 of 10% of 96,000, which give us 2,400. 2,400. After that, we go to the website. Website, we know we are supposed to claim the wear and tear allowance at the rate of 25%. So, wear and tear allowance on the website, which is 25% of, maybe we should start with the periods, 9 over 12, 3 over 12, of 25% of 130. So we'll have 9 divided by 12 times 25% times 130, which we have 24,375. The other one is 3 over 12 of the same, 81.25. So I want us now to continue with the computer, but we continue with it here. So we claim the wear and tear on the computer now. Wear and tear allowance on computer, which we take 9 over 12, 3 over 12 of 25% of. The computer is 180,000. So we will have 9 divided by 12 times 25% times 180. That gives us 33,750. The other one is 3 over 12 of the same, 11,250. After that, we come to the computer program, another 25% wear and tear. So we have 9 over 12, 3 over 12 of 25%. Computer program is 120,000. So we have 9 over 12 times 25% times 120,000 give us 22,500. The other one the same, but for 3 months, give us 7,500. The next one in line is the neon sign, wear and tear allowance on the neon signs. Have 9 over 12, 3 over 12 of neon sign wear and tear allowance rate is 10%. So 10% of the neon sign, 92,000. So we'll have 9 over 12 of 10% of 92,000. 69. The other one is 3 over 12 of the same, 2,300. Now that is the end of the expense we are looking for, the allowable expense not in P&L. So with that, we can now get the net taxable operating. incomes. So what you do, we start with this net profit provided. We add the figures we are supposed to add. We minus the one we are supposed to minus to get the net taxable operating income. So in this case, we start with 829,000, 829,125, 829,125 plus 72,000 plus 93,450 plus 97,500 plus 27,120 plus 258,675 plus 135,000 plus 90,000 plus 72,000 plus 222,000 plus 56,250 plus 120,000 and then plus 69,000 plus 45,000, and then that we minus the 540,000, we minus 111,600, we minus 60,000, and then we minus 7,200, we minus 24,375, and then we minus 33,750, we minus 22,500, and also 6,900. That gives us 13,795. Then we go to the company. We start with 276,375, and then we add 24,000, and then we add that 150, and then we add that 2,500, and then we add 90,50, we add 86,225, we add 45,000, and then we add 30,000, we add 24,000, we add 74,000, we add 18,750, we add 50,000, we add 100, and then we add 60,000, we add 23,000, and then we minus 180, we minus 37,200, we minus 20,000, we minus 13,500, we minus 2,400, we minus 81,25, we minus 11,250, we minus 7,500 and 2,300. That gives us 601,775. Now here we are. We have determined the net taxable operating income of each business. Then how do we move from here? What you need to remember is this: we said For the partnership, once you get the net taxable operating income, you normally go and distribute to the partners. Unless you are told to prepare the income distribution schedule, it normally ends here for this statement. Unless you are told to prepare the income distribution schedule to determine the taxable income of each partner, and then maybe you determine the tax. But for the company, because you tax the company itself on its own income, once you get the operating income to be positive, you don't end there. Because now that is just one source of income for the company. They are not sharing. You just tax the company on itself. So once you get the operating income to be positive for a company, you normally continue by adding taxable investment incomes. Taxable investment income. So for this question, we had two investment income. In the income statement, among the incomes, there is rental income. Rental income, we said, unless you are told it's a residential, we assume it's commercial and so is taxable. However, we said we tax net after allowable expense. So was there an expense relating to rent? Yes. When we were dealing with non-allowable expense, we saw there is loss on rented property. Remember we said loss are allowable expense until a maximum of 10 years. So unless you are told it has exceeded 10 years, it's allowable. So we'll come here and have, and it's good to indicate that it's for the company, not the partnership. We are not interested in the partnership. So for the company, we start with rental income. So we take 3 over 12 for the company. Of the rental income, which you have 148,800, but we less the allowable expense relating to that, which in total is 36,200. So minus 36,200. 148,800 minus 36,200. That times 3 divided by 12 gives you 28,150. And then there is another investment income, interest on fixed deposit account. Now, if you go to the categorization of interest we talked about, when we were looking at the taxation of investment income, we said interest from a bank, because the bank is the one that operates fixed deposit account, which is received by a limited company, fall under non-qualifying interest. Non-qualifying means withholding tax is not final. We need to tax it together with other incomes here. So, interest from fixed deposit. So where we take again 3 over 12 of 80. So 3 over 12 of 80 give you 20,000. So 20,000. And now that there is no other investment income in this question, we can now get the total taxable income of the company. So we'll take the 601,775 and then we add 28,150 and then we add 20,000. That gives us 649,925. So for the company, that become the taxable income. So if you look at the required number 1, up to that point we have answered that. Separate statement of adjusted taxable profit or loss for Wenda Enterprise and Awado Limited for that year. Here, this and this. But it is not the end of the question. If you look at the required number 2, we have the tax payable or refundable to Dawado Limited for the year 2016, tax payable. So Dawado Limited is the company, limited company. So we want to know how much is the tax payable. So we normally say tax payable by Dawado Limited would be, we said the company is taxed at the rate of 30%. So 30% of the taxable income, 649, 925. But we had said, if you have an investment income here, and which was subject to withholding tax, the withholding tax must be deducted from the tax to be paid by the company. And we had one, interest from fixed deposit account. Those incomes are always subject to withholding tax by the bank before they pay you, before they paid the company. And the withholding tax under non-qualifying interest, we said is 15%. So we will deduct 15% of the 20,000. So how much will that be? We take the 30% of 649 and 925. That gives us 194. 977.5 minus 15% of 20,000. That gives us 3,000. So that gives us 194, 977.5 minus 3. Give us 191, 977.5. And that is the end of the question. There is no other question that we have there. So if you have conversion of a partnership into a limited company, that is how we can deal with the question, where you are told we will start with the net profit. Remember we said we always use the gross profit method unless it is stated otherwise. So I would like us to look at another question for the same, but you see when we can use the approach of the gross profit method. So I would like us to look at another question, but this one will be in our next session. So hope to see you in our next session.